Feeling a little nervous about where your hard-earned money is sitting? Wondering if your cash is truly safe, especially in today's unpredictable financial landscape? You're not alone. We all want peace of mind when it comes to our finances, and a big part of that peace comes from knowing our deposits are protected. That's why today, we're diving deep into a topic that's absolutely crucial for anyone banking with Relay FDIC insurance. Now, you might be thinking, Relay? Isn't that a fintech company? Do they even have FDIC insurance? And that's an excellent question, one that gets to the heart of what we're going to explore. Unlike traditional banks that hold your deposits directly and are often FDIC insured themselves, many modern fintech platforms operate a little differently. They partner with underlying banks to provide their services, and it's these partner banks that typically carry the FDIC insurance. So, while you might interact primarily with the Relay app or website, understanding the role of their partner banks is key to understanding your insurance coverage. This isn't just some dry, technical detail. This is about protecting your business's cash reserves, ensuring your operating capital is secure, and safeguarding your future. Imagine the scenario. You've built a successful business, you've got a healthy balance in your Relay account, and then, something unexpected happens in the financial world. What then? Knowing you're backed by the full faith and credit of the U.S. government through the FDIC can be the difference between a minor blip and a major crisis. So, let's cut through the jargon and get to the bottom of it. How exactly does Relay Bank FDIC insurance work? What steps can you take to ensure your funds are covered? And what are the nuances you need to be aware of? Stick around, because by the end of this video, you'll have a crystal clear understanding of how to get Relay Bank FDIC insurance and, more importantly, the confidence that your money is secure. First things first, let's demystify what FDIC insurance actually is. FDIC stands for the Federal Deposit Insurance Corporation. It's an independent agency of the United States government that protects depositors of insured banks and thrifts against the loss of their insured deposits in the event of an insured bank failure. Since its inception in 1933, no depositor has lost a single penny of insured funds due to a bank failure. That's a pretty strong track record, wouldn't you agree? The standard insurance amount is currently $250,000 per depositor, per insured bank, for each account ownership category. This is a crucial point, and one we'll revisit when we talk about maximizing your coverage with Relay. Now, how does Relay fit into this picture? Relay is a financial technology company, not a bank itself. This is a vital distinction. Instead, Relay partners with FDIC-insured banks to provide banking services to its users. Currently, Relay partners with Thread Bank and Evolve Bank and Trust. When you open an account with Relay, your deposits are held at one or both of these partner banks. And because these banks are FDIC insured, your funds are protected up to the standard limits. So, the very first step to ensuring your Relay funds are FDIC insured is simply by having a Relay account. By default, your funds held with Relay, through their partner banks, are eligible for FDIC insurance. There's no extra form to fill out specifically for FDIC insurance when you open a Relay account, as the insurance is provided by the underlying partner banks. Relay makes this clear on their website and in their terms of service, often highlighting their partnerships with FDIC-insured institutions. But here's where it gets interesting, and where understanding the nuances can really benefit you, especially if you're a business with substantial cash reserves. Remember that $250,000 per depositor, per insured bank, per ownership category limit? This means if you have more than $250,000 in your Relay account, and those funds are all held at one partner bank, a portion of your funds might not be insured. This is where Relay's multi-bank strategy comes into play, and it's a significant advantage for businesses. Relay often distributes your deposits across their partner banks to extend your FDIC insurance coverage. For example, if you have $500,000 in your Relay account, Relay might hold $250,000 at Thread Bank and another $250,000 at Evolve Bank and Trust. In this scenario, because the funds are held at two separate FDIC-insured banks, your entire $500,000 would be fully insured, assuming both banks are unique entities in terms of their FDIC insurance. How do you know if your funds are being distributed across multiple banks? Relay's platform is designed to handle this automatically for you. They aim to maximize your FDIC coverage. However, it's always a good practice to review your account details and any communications from Relay regarding your deposits. They often provide information on which partner banks are holding your funds. If you have any doubts or questions, reaching out to Relay's customer support is always a good idea. They can provide you with specific details about your account and how your funds are distributed. Now, let's talk about ownership categories. The FDIC insures different types of accounts based on who owns them. Common ownership categories include single accounts, owned by one person; joint accounts, owned by two or more people; certain retirement accounts, such as IRAs; business accounts, such as sole proprietorships, partnerships, and corporations. For most Relay users, especially businesses, your account will fall under a business ownership category. The $250,000 limit applies to each of these categories at each insured bank. So, if your business has a Relay account, and you also have a separate personal account at one of Relay's partner banks, those will be insured separately under their respective ownership categories. What if your business has multiple entities? Let's say you operate two distinct limited liability companies, LLC A and LLC B, and both have Relay accounts. If both LLC A's and LLC B's funds are held at the same Relay partner bank, e.g., Thread Bank, and each LLC has over $250,000, you'll need to consider how the FDIC views those separate entities. Generally, legally distinct entities are insured separately. However, it's crucial that these entities are genuinely distinct legal entities with separate tax IDs. This is a point where consulting with a financial advisor or legal professional familiar with FDIC rules can be extremely beneficial to ensure your entire business portfolio is adequately covered. It's also important to stay informed about any changes in Relay's partner banks or FDIC regulations. While Relay strives for maximum coverage, the financial landscape can evolve. Regularly checking Relay's official website, their terms of service, and any announcements they make will keep you updated. The FDIC also has a wealth of information on its website, including an electronic deposit insurance estimator, EDI, that can help you calculate your insurance coverage. While EDI is primarily for direct bank accounts, understanding its principles can help you grasp how your Relay funds are ultimately insured through their partner banks. With that said, thanks for watching, and until next time.